All right, so here I have the text and the summary version with my notes. Secure Act 2.0, here we go. So I'm going to go over what I think is most important for individuals and small businesses. We're not going to cover everything. I'm just going to go through it briefly and add my 2 cents. It's a lot, so let's go ahead and get started. So here's the summary version that I'm going to pull up on the screen as we go through it. And again, I'm not going to be able to touch on everything, just give you the brief overviews. If you have questions on a particular section, just let me know in the comments down below and I'll do it on future videos. I'm sure I'm going to do a lot of videos on this stuff. So starting with section 101, that's expanding the automatic enrollment for retirement plans. This is your 401k or 403b, and it's going to start at an automatic enrollment once you are eligible to be into the plan. It's going to start at 3%, and then it's going to go up by 1% per year, up to a window of either 10% up to a maximum of 15%. That window will be determined by the employer. This is only for new plans. Existing plans are grandfathered in, so however they're currently set up, they're going to stay as is. But if a new plan is started at your workplace, then it will be required. They have this automatic enrollment, which you can opt out if you're an employee, and if you're an employer, they can opt out of the plan. So moving on to section 102, this is the modification of the tax credits for small employer pension startup costs. This is going from 50% up to 100%, and this is for employers with up to 50 employees. And in addition to that, you're also going to get a tax credit up to $1,000 on those matching dollars per employee. So yeah, you do want to get those employees to contribute to their own retirement plans so you can give them the match and get a nice tax credit on that. Now, a lot of the dates are going to be at the end of each one of these sections you're going to see right here. And some of these are going to go into effect in 2023, but some of them are in 2024 and beyond. So just pay attention to that start date. And this is one's going into effect in 2023. So that's where we are right now. So section 103. The Savers Match. This is the Savers Credit. That's what this is. So the Savers Credit is you get a credit for contributing to your own retirement plan. In this instance, it will be a match in the form of a match that you'll have to put into your own retirement plan. And it's going to be up to 50% into either your IRA or your workplace plan. So if you're saving, you can get up to $2,000. So basically, if you save up to $4,000 or $4,000, you're going to get $2,000. And this has to go into your retirement plan. Phase out similar to the Savers Credit. This is going to be for married filing jointly, $41,000 to $71,000, and it is half for singles from $20,500 to $35,500, and also for married filing separately. And then it will be 3/4 for at $30,750 to $53,250 for head of household. But this won't go into effect until 2027. Moving on, we're going to look at section 106. That is multiple employer 403b plans, also known as MEPs, multi-employer plans. They've been around for a while, but these plans basically make 401ks and 403bs easier to manage, and it's taking multiple employers and kind of pooling them together under one plan. Now, the employees really won't know any difference. They're just going to see a plan with funds that they can choose, that they can save into with basically all the same rules. And this just makes the administration of it a little cheaper, easier to administer. So that's what this is doing right here. Section 107 is going to be increasing the age for the RMDs, or required minimum distributions, or it's saying here required begin dates for mandatory distributions. It's going from 72, which is what it is right now, and that has been increased since the last Secure Act. This is going to age 73, starting in January 1st of 2023, and this is going to go up to age 75, starting in January 1st, 2033. So the whole name of this game of the Secure Act is really to get you to save and make it easier to get through retirement. This is delaying it. People are living longer, working longer, and it just makes sense to increase these dates. The next section, section 108, is indexing the IRA catch-up limits. So this is taking that $1,000 additional. If you're 50 or older, that's 50 or older, you can do an additional $1,000 into your IRAs. This is just going to be indexed, meaning it's going to continuously increase each and every single year. Moving on to Section 109. So this is a higher catch-up limits for those from age 60 to 63. It says 61, 62, 63. So 61, 62, and 63, you can do an additional catch-up or an increased catch-up contribution. Now it's going to start at $10,000. Here it says $10,000 or 50% more than the regular catch-up limits in 2025 for individuals who have attained these ages. If you do the math, 6,500 multiplied by 1.5 is going to be less than 10 grand. So it's going to start at $10,000. So again, if you're 50 or older, this is going to be increased, but this doesn't start until 2025. Section 110, the treatment of student loan payments as elective deferrals for purposes of matching contributions. So if you have student loans, you're paying off your debt, you can now qualify to get those matching contributions from your employer. However, it's important to note that this is optional for the employer. So it's not a guarantee. So if you have a workplace plan, you're thinking, oh, I have student loans, this is going to be great. I could pay them off, get the match. Not so fast. You have to make sure that it's added to the plan. Moving on to Section 113. This is the small immediate financial incentives for contributing to a plan. In a nutshell, this is a bribe. This is allowing employers to offer things like gift cards. You can see it right here. It says low dollar gift cards to boost employee participation in workplace retirement plans. So you saw all of those tax credits that the employer can get. Well, you need the employee to actively participate in their retirement plan in order to get those tax credits. So they've allowed small bribes, basically what it is. So moving on to Section 115, withdrawals for certain emergency expenses. So in a nutshell, you could take out up to $1,000 out of your retirement plan and avoid the penalty. If it is pre-tax, though, you have to be aware that it's going to be added to your ordinary income. But you also have the option to repay it up to 3 years. So the option to repay the distributions within 3 years. We saw something like this during the pandemic with taking money out of your 401ks and then be able to repay it back. This is an emergency, so you can take out up to $1,000. Going to Section 116, this is allowing additional non-elective contributions to simple plans. So the employer can add up to 10% with a maximum of $5,000, which is going to be indexed. Now, this means that the employer could basically do a match, but you can't pick and choose who you're going to give it to. You have to give it across the board to the entire plan, and it can be up to an additional 10% or a capped at $5,000. So it's making the simple plans, I guess, a better plan overall, being able to contribute more to the employees. Moving on to Section 117, a contribution limit for simple plans. This is going to allow you to increase it by up to 10% for both the annual deferral limit and the catch-up contribution limit. So that is going to be eligible for an increase. It's worded a little strangely, but they're just going to take whatever the limit is and then add an additional 10%. Moving on to Section 118, the tax treatment for certain non-traded or business SEP contributions. Basically, you can open up a SEP for your housekeeper. So it says it right there. That's the example, nannies. So you can use it for domestic employees and open up a SEP IRA. A SEP IRA is only employer funded. So if you wanted to give a benefit to your nanny, open up a SEP IRA and you can make that contribution. They can't also contribute to the plan. It's only employer funded. Moving on to Section 121, starter 401k plans for employers with no retirement plan. Kind of a strange one. So the starter 401k, I don't really know why you would do it, but the default enrolled in the plan at 3 to 15% of compensation deferral rates. And it's going to be the same as an IRA. So I don't know really why you would start with this type of a plan. Maybe it's going to be easier to administer. Maybe it's cheaper. At this point, it's not entirely clear, but they're putting caps. So you don't have the regular 401k limits. They're the same limits as an IRA. So, which really doesn't make a whole lot of sense. And even you can see the catch-up contributions at $1,000. So it's basically taking the same limits as an IRA and applying it to the 401k plans. But a lot of these plans are relatively inexpensive. So I don't know how this plan would be necessarily cheaper to administer than a regular 401k, but start a 401k plan. Section 125, improving coverage for part-time workers. So it's reducing the 3-year rule to 2 years. So to become eligible as a part-time employee. And this is going to be effective in 2025. Moving on to Section 126, special rules for certain distributions for long-term qualified tuition programs to Roth IRAs. So this is an interesting one. Not really as good as I was hoping, but here's the deal. You could take money from an old 529 or any 529 and start to roll it into your Roth IRA up to a maximum of $35,000, but that's a lifetime maximum. And it also eats into your contribution limit. So, and I know a lot of people are probably looking at this one thinking, oh, this is going to be great. Put more money into the 529, roll it to my Roth IRA. But what you lose is your eligibility to contribute to the Roth. So if you're contributing, say, $6,000 to the Roth, you can't also roll the 529 money in lots of $6,000 up to a lifetime maximum of $35,000. It eats into your contribution. So maybe if there's a year you just can't contribute, but you have this old 529, I don't know. Maybe that'll be something that somebody wants to do. I would prefer, and me personally with this, is that I would keep the money in the 529 plan because you're still getting the tax deferral. You don't have to take it out, and you can use it for other beneficiaries. But there is an option to roll this into a Roth IRA. You're still getting that tax deferral, and then you'll be able to take it out tax-free later on for other expenses. But again, why would you do that? I don't know. If you're going to have money left over in a 529, I would probably just keep it for the other beneficiaries. Now moving on to Section 127, the emergency savings account linked to individual account plans. So this is setting up basically a savings account for the employee where they can save up to 3% of their salary, and this will go up to a maximum of $2,500 and then divert to the retirement plan. And the premise here is that about half of Americans only have about $400 to meet an unexpected expense. So they're trying to fix that rather than saying, save into your retirement plan, and then later on you can take it out with all these penalties for early withdrawals. They said, you know what? We need to fix this issue. So they rolled out this provision to allow employers to have these extra plans that are basically bank accounts where you're saving the 3%. If you don't take the money out, over $2,500 will then be diverted over to a Roth-like retirement plan. That's what it's saying here. Roth-like basis and treated as an elective deferrals for purposes of retirement matching contributions. So that's where those dollars are going to go. Moving on, going on down, continuing to Section 302. So 302 is the next one, reduction in excise tax on certain accumulation and qualified retirement plans. So this is if you do not take the money for your required minimum distributions, and it's dropping from 50 to 25%. Now, this also is kind of worrisome, even though it's dropping, because previously the IRS didn't really get on your case too much if you didn't take it out. You could just basically write a letter to them. And it sounds like maybe they're not going to be so lenient on that anymore, especially if they're increasing the R&D age. And they've got to take the revenue from somewhere. So yeah, it's good they're dropping it, but maybe they won't be so lenient as they've been in the past. So hopefully they are, but that's what's happening there. So is it a win? Maybe. We'll have to wait and see. Section 303, retirement savings lost and found. Kind of a good thing, but also not a great thing. So they're basically going to create a database for all old retirement plans so you can find them easier, but they also are going to track them. So I don't know. Do you like that provision or not? Let me know in the comments down below. But that is Section 303. Moving on to Section 313. Let's scroll on down here. And this is the individual retirement plan statutes of limitations for excise tax on excess contributions. So this is for excess contributions and certain accumulations. Certain accumulations are the RMDs. So the excess, you can see it right here. Excess contributions and required minimum distributions. So in order to provide financial finality for taxpayers in the administration of these excise taxes, it's saying rather than waiting until you file the form, it's saying from the time of your original time that you should have taken the money or you made the overcontribution, it's going to be 3 years from that point. And it's going to go, in which case the period of limitations runs 6 years from the date of the 1040 was filed. So that is for the excess contributions, in which case the period will go up to 6 years. Again, it's a hard one because these are things that you usually catch pretty quickly, but for those that don't, they won't get just hammered with all the penalties, unfortunately, by making those excess contributions. And you see that a lot, unfortunately, when people try and do it themselves, rather than making sure they're doing it correctly. They say, hey, I'm going to make this contribution to this retirement plan, and then I'm going to have this other broker dealer make that contribution to that retirement plan, or they do it on their own. But anyways, this is making it, I guess, giving it, like they said, some finality to it, where you don't have taxes and penalties that go on forever. Section 314, penalty-free withdrawal from retirement plans for individual cases of domestic abuse. So that's basically in a nutshell what it is. Penalty-free withdrawals on it. I don't know how that gets determined. Does somebody have to go out and file domestic abuse claim just to get the money out of their retirement plan? That's a tough one. Section 315, reform of family attribution rules. So this is the common ownership. If you're not familiar with this as a small business owner, you can't have a retirement plan XYZ over here for this company, and which has no employees, and then have another company over here which has employees but no retirement plan, because it's common ownership. So you have to do that. You have to offer the plan to everybody. In addition to that, it's saying, well, we have to level the playing field somehow. So let's say that you have your kids own some stock or dependents, or you have your spouse own it. They basically said, you know what? There's issues with common law ownership here, or common ownership in certain states. Then we're going to make it a even playing field for everybody. So everybody has to be included into these retirement plans. If your kids own businesses or your spouse owns a business and you own a separate business. So if you're trying to keep everything separate in order to prevent people from saving into their retirement plan or being offered a retirement plan, no more. That's what this provision is doing. So it's reform of family attribution rules. Section 316. So this is the amendments to increase the benefit accruals under plans for previous plan years allowed until the employer tax return due date. So now we can do amendments up until the tax filing deadline, including extension for the benefit of the employees. So pretty cut and dried there. You can do that up until you file your taxes. For Section 317, retroactive first-year elective deferrals for sole proprietors. So this is the solo 401k issue that if you open and fund the plan after 12/31, then it was making it difficult to go back and put in the employee contribution, because technically you're supposed to pay yourself throughout the course of the year and make deferrals into your retirement plan. But we all know that that's not really reality for small business owners, because if we procrastinate, we don't know where the net profit's at until we get to the end of the year. So they're allowing those new small business owners that want a retirement plan to open and fund and be able to do it. Although this is kind of a little bit of a loophole previously. So this is just, in my opinion, just kind of cleaning everything up and saying you can make that employee deferral rather than just the employer deferral. Let's go to Section 322. So this is the tax treatment of IRA involved in a prohibited transaction. Only the IRA with respect to which the prohibited transaction occurred will be disqualified. So this is for those that are using their IRA money to buy rental properties or small businesses, or possibly even like cryptocurrencies and stuff. So if you're doing, I don't want to say bizarre, but different transactions, not the normal transactions, and you make a mistake in doing it, then it's only going to target the individual IRA that you're dealing with. So if you have multiple IRAs or one IRA, a big IRA, you want to kind of separate it away if you're going to do a transaction that could potentially be subject to a prohibited transaction, because then it's going to basically say this is no longer an IRA. And then it's going to have some significant tax consequences. So keep yourself out of hot water. I wouldn't even do these alternative transactions anyways. So I don't talk about it on this channel at all. So just stick with your stocks and your bonds inside of your IRA accounts. That's what I would do. So anyways, Section 323, classification of substantially equal periodic payment rules. So it looks like you can make changes when you're still making these substantially equal periodic payments. If you don't know what this is a way that you can actually get money out of your retirement plan before you're 59 and a half. You could take it early as long as you're doing substantially equal periodic payments. There's a few formulas in doing this where you can start to take the money out, basically in an annuity format early. And it looks like we can now make some changes, roll the money from one brokerage account to another. That's what it's basically looking like for Section 323. Section 325, Roth plan distribution rules, eliminates the pre-death distribution requirement for Roth accounts in employer plans. So this is going to be for those that have a current workplace plan. They are subject to RMDs for the Roth account if you have a Roth 401k. So now that's being eliminated, which puts it on an even playing field with Roth IRAs, which don't have RMDs, required minimum distributions. So now Roth 401ks are just like the Roth IRAs. So you don't have to worry about rolling that Roth 401k over to a Roth IRA to avoid the RMDs out of your Roth 401k. Even though it wasn't taxable, you still have to take the money out. So now that's gone. Section 327. So that's surviving spouse election to be treated as an employee. So this is the possible spousal RMD is reduced. That's basically what this is saying. So if your spouse passes away and they have a workplace plan, they can take a look at that plan and say, we don't have to take the deceased's RMD. We can take it based on your age instead, or vice versa. So it kind of gives you some flexibility. All you would need to do is, if your spouse died, is take that money and roll it into your own retirement plan, or you can leave it as is and use their age. So it kind of gives you some flexibility, or at least that's what it's sounding like to me. Gives you some flexibility in the calculation for the RMD. Section 332, simple IRAs. Employers allowed to replace simple retirement accounts with safe harbor 401k plans during the year. So you don't have to wait until the end of the year, because you can't have another retirement plan with a simple IRA. So it's allowing you to make that change throughout the course of the year. Easier to manage, easier to flip it over. And simple IRAs are usually a pretty good starter plan if you have a few employees or a handful of employees. And then when you decide that you want to save in more, have a more robust plan, then you can jump to the 401k. Or you can jump to the simple 401k or the regular 401k. Section 333, elimination of additional tax on corrective distributions of excess contributions. So the excess contributions is basically waiving the 10% penalty, which is kind of nice. That's a big deal. It's a little bit of money, but it's just another calculation. It just, when you're going through all of this excess contributions, it's like, eek, you saved, $1,000 or $2,000 more, and you're just dealing with these taxes and penalties. Now, you still have to add it if you pull the money out. If you end up pulling the money out, you still have to add it to ordinary income, but if it's a pre-tax account. But the additional 10% is now gone. So kind of nice that they made it a little bit easier. So don't lose sleep if you make a mistake. It's make the contributions throughout the course of the year. If you need to take it out, you could take it out and avoid the 10% penalty. Moving on to Section 601 with simple and SEP Roth IRAs. So now both of those accounts have a Roth side to them. But would I still choose them? Probably not in most instances, because they're still IRAs and they get roped into the backdoor Roth as the pro rata rule. So if you have that pre-tax money in your SEP, that makes it difficult to do the backdoor Roth. Section 603, elective deferrals generally limited to regular contribution limits. So what this is saying, that the catch-up contributions for those with compensations of over $140,000 or $145,000 or more will have to put it onto the Roth side for those catch-up contributions. So you will not be able to take your catch-up contribution and put it in pre-tax to lower your taxable income. It will have to go over to that Roth side. And also on Section 604, this is the optional treatment of employer matching. I didn't even highlight this one. Optional treatment for employer matching or non-elective contributions as Roth contributions. So those matching contributions can now go to the Roth side of your retirement plans. And this will also work for the matching contributions that you might get if you have have student loans. So you can say, hey, I'm paying off my student loans. I want my match. But hey, by the way, I would like that match to go to the Roth side of my retirement plan. So that's actually kind of a nice benefit if you're early in your career, and it usually makes more sense to put it into the Roth side. You can get those matching dollars into the Roth side. Of course, you can do that at any level with the matching dollars, but those are instances where it makes a little bit more sense to do so. So this is the Secure Act 2.0 that we went through today. If you have questions, comments on this, let me know in the comments down below. I'll do more videos on this, and subscribe, and we'll see you on the next one.